So joining me now, SlateStone Wealth Chief Equity Strategist, Erin Gibbs. Well, it sure is nice to see retail looking so muscular.
It is. It's really interesting. And I think what's interesting with the Home Depot and Lowe's, those are obviously your bigger purchases. We're not talking about the lower end consumer and small little purchases. So I think that's good that we're seeing some slight improvement, even though it was a tough beat for them. I think what I'm really looking forward to seeing how Walmart does tomorrow, because obviously that's the one that really sets the tone for the retailers, particularly when it comes to, if we're talking the K-shaped economy, that bottom part of the economy, of how those consumers are really feeling the impact of tariffs and oil prices and so on, and how that's going to go. But Estee Lauder was just such a great breakthrough. That was a really nice piece of news to watch, because they've been struggling for a while.
Yeah, they didn't have to slap any lipstick on it. The numbers themselves were really good. Walmart, though, I find very interesting as well, because it's turning negative in the late part of the session here, just slightly.
Right.
But ahead of earnings, investors don't want to take too many chances here. But yes, it will give us a window and give you guys out there a window into the health of both ends of the consumer spectrum.
Right.
We got to talk about this bond intervention. It's an intervention, isn't it? I mean, this morning, the Treasury Department said it would double the amount of, well, let's keep it simple, bond purchases, at least just for a short period of time, because yesterday, the 30-year yield spiked to 19-year highs, and it was followed by a lot of other longer-term, longer-dated treasuries across the world hitting pretty significant highs.
I think when we start using the word double, not just a 10% increase at 25, but going from 2 trillion to 4 trillion, that obviously says that Besant flinched, and this is an intervention. I think that's completely the right way to call it. And so I think not only looking at the 30-year, because obviously that's what they wanted to have the impact on, but even what the 10-year is doing, because obviously just for me and looking at how, that's the one that really impacts the economy and the stock market. And that finally going down from its high of about 475 to whatever 460 it is about right now. But seeing if we can keep that 475 as a ceiling going forward, that's going to be really important for the economy and the stock market.
10-year.
Yeah, the 10-year going forward.
The 2-year of the 30, by the way, really underscores the reaction.
Yep.
It's a pretty violent reaction, falling nearly 9 basis points after Treasury made that announcement. Okay, that said, the concern that spiked Treasury yields was multifold, I think. It was that we're nearing $40 trillion in debt for the United States, and that's a big problem, but also that people are looking for much better yield because they're a little concerned. Today, the tech stocks, some of them look pretty decent. You like tech at all here?
I do. I like tech for a lot of reasons, and also even companies that have higher debt exposure. I think they're all very attractive right now because productivity gains are there. And I know this is tangential, but the Moderna announcement just shows you what technology can do and just how much that can spike. So I think even if we're seeing some of those higher bond prices, yes, so higher lending rates, given the productivity gains that we're looking at from these companies, that's going to compensate even if we have these higher interest rates.
Really quick, because I mentioned it, we got the Fed minutes from the most recent meeting, which was late July. And what it revealed is a couple of things that were pretty interesting. You had some of the officials saying that generally they saw upside risk to inflation. Many officials said rate hikes could be needed if inflation does not decline. But what is kind of titillating here is that the new chair, relatively new chair, Kevin Warsh, said fewer meetings would allow for more information and data to drive interest rate moves, meaning accumulating more between meetings. Right now, there are 8 meetings a year, but with the Federal Open Market Committee, and he mentioned maybe going to 6. No decision made, but you, as somebody who watches stocks every day in the markets, would you rather see 8 meetings or 6?
For me, I'd still like 8. But I'm a data person. I like more information. But I think, yes, some of the volatility that comes, some of maybe the mistakes that the Fed has made in the past, if they had had time to amass more data, some of those would have stopped them. On the other hand, when it came to the Fed finally calling inflation non-transitory with COVID, honestly, they could have moved quicker. And so whether it was 8 or 6 back then, it didn't help because they still stalled. So I think it's still ultimately about the leadership within the Fed and how they view things. Whether they're meeting 6 or 8, they have to be able to react to things quickly enough.
Yeah, that's true. And yeah, I like data too. We're both geeks. Erin Gibbs, pleasure to have you.